Almost nothing about the self-employed side of mortgage brokering will catch you out harder in your first year than tax. Not sales, not the compliance, not the lenders, tax. Because the moment you leave employed work and become self-employed, the entire system that used to handle your money for you, so your PAYE, your pension contributions, national insurance, the tax code, the payroll department, just disappears completely. And in its place is you, holding a spreadsheet, wondering what you're supposed to do with the prop fees landing in your bank account. So this video, by the way, it's not going to give you tax advice. Please understand that I am not a tax advisor. And if any YouTube video tries to give you specific tax advice for your situation, you should find a qualified accountant. What this video is, though, is going to give you the framework, the things you need to understand before you go self-employed, the questions you need to ask, and the specific decisions you'll face, so that when you do sit in front of a real qualified accountant and tax advisor, you're an informed client and not a confused one. Now, here's why this matters so much, is that every year in this industry, new self-employed brokers get to January, sit down to file their self-assessment for the first time and discover they owe HMRC a 5-figure tax bill that they don't have the money to pay. Not because they earned too little, but because they spent all the money that came in as if it was their money. And they never realized that a chunk of every proc fee, every broker fee, every commission check actually belongs to the tax man until the end of the year. That single misunderstanding has ended more self-employed broker careers than any lender panel change or market slowdown at all. And it's also completely avoidable, but only if you understand the structure of what you're walking into before you walk into it. Tax bills don't kill self-employed brokers, but surprise tax bills do. And this video is the framework for making sure that you hopefully never get surprised. Now, the single biggest mindset shift when you go self-employed is that you are not really a self-employed person. You're a business. The prop fees, the broker fees, and commission that lands in your bank account, they aren't actually your salary. They're what we call your revenue. And a proper business separates revenue from personal income by structure, by discipline, and by paperwork. The brokers who get this right open a dedicated business account on day one, pay themselves a fixed personal salary out of it every single month, and treat the business account like an employer that they happen to own. The brokers who get it wrong, though, they let all the money hit one account, spend it as it comes, and try to figure out the tax at the end of the year from an inbox full of receipts. Only one of those approaches survives contact with an accountant. So which specific business structure should you use as well? Sole trader, limited company, partnership is a decision that depends on your income level, your goals, your family situations, and a handful of other things. And that's a decision to make with a qualified accountant, not on a YouTube video, okay? But you need to understand that the decision exists, and it's usually made in your first 3 months of trading. Now, the single biggest structural decision that you're going to face is whether to trade as a sole trader or a limited company. Both are legitimate, both are common for mortgage brokers. And the right answer purely depends entirely on your circumstances. At a high level, sole trader is simpler. Less paperwork, less accounting, everything you earn is treated as personal income and taxed at your personal income rate. It's the easier setup for brokers who are just starting out and expect to earn modestly in their maybe first year or two. Limited company, though, is way more structured. You become a director and a shareholder of your own company. The company earns the money. You take the money out of the company as a mix of salary, dividends, and pension contributions, each of which is taxed differently. It's typically more tax efficient at higher income levels only because of specific tax treatment that changes budget by budget, and only if it's set up to run properly. Limited companies also require formal accounts filed with Companies House, which means more accountancy work and more cost involved. The rough shape of the decision most accountants will guide you through is that sole trader, while income is relatively low, limited company once income crosses a certain threshold. But that threshold moves and the tax treatment changes with each budget, and the right structure for you personally depends on things like whether you've got a partner earning separately, whether you want to keep money in the business for growth, and how you're planning your pension. See, the specific answer isn't the point. What matters is this: the decision exists, it's meaningful, and you need to make it with proper advice, not on guesswork. And please, not asking ChatGPT or AI. Now let's talk about VAT, and this is genuinely probably one of the most misunderstood bits by beginners, including some brokers, by the way, who've been in this game for years. Mortgage brokering is classed as a VAT-exempt financial service, and what that means in plain English is that when you charge a client a broker fee or a lender pays you a prop fee, you don't add VAT on top. Same for protection commission, same for the core work of mortgage advice. It's all exempt, which sounds like great news, and it is in some ways. You don't have to charge your clients 20% on top of your fee, which keeps you competitive against anyone who does, but there's a trade-off. And this is the bit that many new brokers miss. Because your income is VAT exempt, you generally can't claim VAT on your business expenses either. So the VAT you pay on your software subscriptions, your office costs, your professional indemnity, your phone, your CRM, all of that stays as a cost to your business. You absorb it rather than reclaim it. And there are a few areas where these things can get a bit more complex. Brokers who earn commission from general insurance introductions, or brokers who do additional services alongside mortgage advice like consulting and training, can sometimes have a mix of exempt and non-exempt income, and that changes the picture. If that's you, or you're planning to build a more diversified business over time, that's a specific conversation that you need to have with a mortgage industry accountant. But the headline for a beginner broker doing pure mortgage advice, protection and general insurance is this: you probably won't need to register for VAT. You won't be charging it on your fees, and you won't be able to reclaim it on your expenses. That simplifies your life in some ways and increases your costs in others. Just know that's the picture, so you're not sitting there in year one wondering why you can't reclaim VAT on your new laptop. The next thing every new self-employed mortgage broker is going to ask is, what can I actually claim as a business expense? Now, broadly, the rule is that legitimate expenses have to be wholly and exclusively for the purpose of running your business. That's the phrase, by the way, that HMRC uses. And it's the phrase your accountant's going to use when it talks to you. So business phone bills, business software subscriptions, CRM costs, professional indemnity insurance, training courses, business mileage, and a portion of your home office costs are typically legitimate claims for self-employed brokers. Things that can get a bit grey, by the way, is laptops used for both business and personal, cars used partly for business and partly for private, meals with introducers, and gifts to clients. All of those have specific rules attached. Some of them can be claimed in part, some can only be claimed within specific limits, and getting them wrong is probably one of the fastest ways to trigger an HMRC inquiry. The specific rules change, the categories move, and the treatment differs depending on whether you're sole trader or limited company. This is exactly the kind of thing a proper accountant handles in 10 minutes, and it's going to save you hours of guesswork. Don't try to figure it out from articles online or typing into AI. Book an hour with an accountant in your first month and get the picture straight for your actual situation. Now, quick pause here. If you are watching this and thinking, actually, I'm real past all this beginner stuff, I want to know how established mortgage brokers structure their business, their teams, and their long-term growth, that's not what this channel is for. This channel is for people starting out. But I do have a second channel called the Mortgage Business Mastery Show, where I put out a weekly video specifically for established mortgage brokers who want to build, scale, and get seriously good results. Sales, retention, systems, hiring, the whole picture. Now, so if you want to get a head start and see where this career actually leads once you've properly got it running, the link's in the description. I'll also pin it in the comments too. Check it out when you get a minute. Anyway, let's get back into this video. Now, the single most important operational habit for a self-employed broker, and the one that quietly ends more careers than any other: saving for your tax bill from day one. Now, here's what happens to brokers who don't. Money lands in your account through the year. It feels like income, so they spend it like income. December rolls around, January arrives, the self-assessment gets filed, and HMRC send a bill for tax and national insurance based on the previous tax year's income. There is not enough money in the account. Panic sets in, payment plans get arranged with HMRC, and then next year's tax is already accruing while the previous year is still being paid off. And within 18 months, the broker is trapped in a cycle they just cannot get out of. Now, the fix is embarrassingly simple. Every time money lands in your business account, immediately move a percentage of that into a separate savings account for tax. Different accountants will recommend different percentages depending on your setup and expected earnings, but the principle is universal. You separate the taxman's money from your money on the day it arrives, not the day the bill lands. That single discipline, built from your first week self-employed, is the single most effective thing that you can do to make sure your tax season is boring and manageable rather than a crisis. It's not complicated, it's not sophisticated, it's just a habit. But it's the habit that separates the brokers who survive their first tax year from the brokers who quietly go back to employed work by year 2. Now, when you leave employed work, one thing that disappears is your workplace pension. Your employer used to contribute alongside you into your pension pot automatically. When you go self-employed, that contribution stops. And if you don't set something up in place, you'll simply just stop building pension savings. Setting a personal pension as a self-employed broker isn't just about long-term retirement planning. There are meaningful tax benefits attached to how pension contributions are treated, which is why so many self-employed brokers use pension contributions as one of the top tools their accountant recommends to manage manage tax liability efficiently. I'm not going to give you specifics on how much to contribute, what type of pension to use, or how to structure it, because that depends on your income, your age, your existing pensions, and your goals. But you need to know that this is a decision to make actively, early, and with proper advice. Sit down with an accountant or a financial advisor in the first 6 months of trading and get the pension question answered. It's genuinely one of the biggest levers that you'll have long term for your financial picture, and one of the easiest ones to accidentally ignore for a decade. Now, because this specific one is probably the most Googled thing in search, a quick word on how the income streams that flow into your broker business get treated for tax purposes. So proc fees, broker fees, and protection commission are all business revenue. They are not treated differently from each other in the sense that all of them count as income to the business. They sit in your accounts as revenue, and after expenses are deducted, the profit is what you're taxed on. The complexity comes from timing. Some commissions are paid on completion, some protection commissions are indemnified, meaning they're paid up front but subject to clawback if the policy lapses within a certain period of time. Some are paid on the drip as a trail income over months and years. Each of those has specific accounting treatment, and getting the treatment right matters because it affects when you record the income, what happens if it's clawed back, and how the tax lands. This is genuinely one of the more nuanced areas of broker accounting, and it's a big part of why you need an accountant who's actually familiar with the mortgage industry. A general small business accountant might do a reasonably good job on the basics, but miss a sector-specific thing around indemnified commission or clawback provisions, and a broker specialist accountant knows this stuff cold. The difference between the two over years is genuinely massively meaningful. Every new self-employed broker asks this: when should I get an actual accountant? So the honest answer is before you take your first case. If you can, that's the way to do it. Not after your first tax year, not when things get complicated, before. Because the decision made in your first 3 months, the structure, the bank accounts, the record keeping systems, the accounting software, are the decisions that make either everything easy for your next 10 years or make everything super painful. What type of accountant matters as well is important. You want someone who specifically understands the mortgage industry. So like we've said already in this video, prop fees, indemnified protection commissions, clawback treatments, sole trader versus limited company decisions for financial services who are VAT exempt. There are plenty of them around, by the way. The mortgage networks often have preferred accountant relationships that they can refer you to. Ask other self-employed brokers as well who they use. Read reviews, interview a couple of them before committing, and the cost of a decent accountant for a self-employed broker is usually going to be anywhere between $600 to kind of $2,500 a year, depending on the structure and the complexity. It sounds like a lot when you're new and cash is tight. Yes, it does, but it genuinely isn't. Once you factor in what a bad DIY approach costs you in your mistakes, missed claims, and unnecessary tax, a good accountant can be actually worth way more, and they'll pay for themselves in year one. Now, once you've got your tax and your structure of your self-employed business all sorted, the next question is how you actually build long-term income inside that structure, because the tax planning matters most when there's something actually to plan around. And that's what the video you want to check out next, which is on screen right now, which is how to build a remortgage pipeline as a new broker. Give it a click.